Let's bring in now CNBC contributor Shannon Saccocia of MB Private Wealth. So what do you make, Shan, of the price action that we've seen really since, let's call it late day yesterday and now through today?
Well, and I think you can somewhat include late day Friday in that, Scott. And I think many of us who are obviously grappling with the devastation that we're seeing in Israel are wondering, what does that mean for the markets for the rest of this year? And I think, the story is really all about yields. Why are yields higher? I think Liz Ann made an excellent point in the previous segment. Are they higher on higher inflation expectations? Are they higher on growth? Are they really higher because we have a supply-demand imbalance in treasuries? And I think what you're seeing is that you're seeing some of that additional supply being sopped up in the market over the last 2 days. It's putting a cap on the 10-year, and that's creating a more fundamentally foundational opportunity for people to buy equities kind of coming into what will be an interesting next 10 weeks or so.
But you don't really believe in the market. I mean, as it sits here, you certainly don't believe we're having a year-end move higher because you want to overweight cash and investment-grade bonds over equities, which you're neutral on. What does that say about your psyche about the market?
So I think it's a tale of two time frames, and I'm so glad you asked me, Scott. Again, the next 10 weeks or so, if you look historically over the last several years when we've had a tough September, the markets have yielded generally a fairly positive outcome in the fourth quarter if you look at the S&P 500. And so it's really all about positioning right now. If we get that cap on yields that I talked about, and we get a little less volatility from a rate perspective, equity investors are going to digest that and position appropriately through the end of the year, which implies that they may plow some cash back into equity markets. Instead, looking forward to 2024, however, this higher for longer implies that we should be longer the stronger parts of the market, which are cash, investment grade, fixed income, and even within equities, thinking about lower beta, higher earnings quality to set up for what we think will be a continued slowing of the economy and, perhaps a mild recession. But to your point, it's very difficult to time, when that switch will flip from late cycle to early cycle. And so just preparing for that continued volatility and compression, if you will, in valuations is how we're positioning into 2024. So
you're willing to forego a rally between now and the end of the year. That's clear. And you don't sound very optimistic.
Well, Can I make a comment on that? Yeah. We are neutral in equities, Scott. I want to make it very clear. We have a neutral position in equities. We are exposed to the equity market. We are not underweight. However, within equities, our view is that you should be rotating perhaps into names, not these high growth names with no profitability, not into deep cyclicals, but instead into companies that are stronger and can withstand some of these forces that are going to buffet them into 2024.
I understand, but if by virtue of your being overweight cash and investment grade bonds and neutral equities, your bias is negative on the stock market right now. It just is.
Well, there are other places that we can be underweight in our allocations, and I think that's important. We invest globally, Scott, so we're a little less excited about non-U.S. developed bond markets, for instance, and emerging market debt, for instance, is something that we have been more optimistic about in the past than we are today. So there are opportunities if you're a global investor. We are overweight and believe that the U.S. equity market is better positioned right now because of the U.S. economy's services-led economy versus the manufacturing-led economies of Europe and China. And so we are putting our emphasis here in the U.S. from an equity perspective and from a fixed income perspective.